So, topic of today's video is I want to talk about a master limited partnership that I own. It's called Enterprise Production Partners. The ticker for this one is EPD. And if you've not heard of a master limited partnership below or before, it is similar to a stock, but instead of being a shareholder, you're a unit holder. And you can buy it just like any stock from a brokerage account. But at the end of the year, you're going to get a K1 statement that you then need to enter into your taxes. So that's one more step that you have to be aware of if you buy a master limited partnership. But it's not that hard of a thing to enter this into TurboTax or H&R Block tax cut. Just be aware that you get that. And Energy Production Partners, again, EPD is the ticker. It has a very high distribution yield. Like, it's similar to a dividend yield, but it's not considered a dividend yield. They pay distributions, and it's called return of capital, which is a really interesting way of getting passive income because return of capital is taxed really differently. Basically, the IRS says you give a company capital, and then they slowly give you your own capital back again. And once they've given 100% of your capital back to you, then your distributions are taxable after that point. So it's called reducing your cost basis in the stock. And so, to be aware, if you ever sell your shares, then all the distributions that you've had over the years become taxable right then at that point. So that could be a potential tax hurdle. And then once you've received 100% of your original capital back, then distributions, as I understand, are taxable at that point. But it can be really interesting if you're a high earner, because if you put your money into EPD, you basically have no tax hit from the income that you're going to get from this stock. And that's good during your high income years. So you basically put your money in one of these, they give you about a 7% dividend. It's close to that. So you get 7% of your money back every single year, but you don't get taxed on it. So if you're kind of in the late stages of your career, maybe you're in the high earning stages, if you buy EPD, you can slowly get your capital back again, 7% a year, not get taxed on it. And then let's say you retire, and then after that is when your distributions become taxable. So it's a really interesting tax structure that can be helpful if you're a high earner late in your career. According to the law of 72, if you divide about 7.2% into the number 72, you're going to get number 10. So what that means is if you're reinvesting your dividends in a 10-year time frame, you're going to double your money. So if you buy $1 million worth of EPD, reinvest the dividends over a 10-year period, you'll end up with $2 million just from the dividends alone. So very interesting. Enterprise Production Partners also has the ability to grow. They move energy across the country. I think they have something like 50,000 miles of pipelines across the country. It's basically a utility. It's infrastructure. These pipelines we have to move oil and gas energy around. So they're not going anywhere. And the tax structure is set up so these companies pass through the income that they earn as these distributions. Enterprise Production Partners has been on a steady growth trajectory since the COVID lows. So, they may continue to grow. I don't know if they'll go up or go down, but they have been on a good trajectory over the past while. And one of the thoughts is these pipeline companies can benefit from the AI power needs because natural gas is most likely going to be the fuel of choice to generate electricity for the AI data centers, at least until nuclear can kick in. But natural gas is it right now. Maybe coal. I doubt you'll burn oil, but who knows, maybe. So natural gas has to be moved around to the data centers, which buy these natural gas turbines. I know Musk's XAI built a bunch of these turbines. There's another new data center project in Texas that I think has 17 of these natural gas generators for a new AI data center. Chances are more and more of these things are going to go up, and that's probably going to help the price of natural gas, and you're going to have to move it around the country. So these are all things that potentially make EPD more valuable. So you may get a 7% dividend yield plus a bunch of capital appreciation as well, which is the perfect combination for a stock. So consider that. All interesting aspects. Do your own research. Take a look at your things. I will say that, oops, I think I bumped the microphone and must have made a sound, but Enterprise has increased their distributions for a lot of years. They didn't lower their dividends in the COVID timeframe like some other companies did. They've been a pretty solid dividend payer for a long time. And so that's something that people really like about this company. And I think they're willing to pay a little bit of a premium for. I think EPD trades, it's not a PE, it's something similar, but they're a little bit more highly valued than something like an ET Energy Transfer that lowered their dividends during COVID. So maybe this shows that this management team is more stable. They think more long term than some of the others, and so I believe that's something that people like about Enterprise over some of the others. So it's an interesting master limited partnership, high dividend yield. If you have $1 million worth of EPD, they pay $73,000 a year. If you have 100,000, then you get 7,300. Those are some really great income levels. And since it's paid out as return of capital, you're not taxed in the year that you receive it. It gives you the ability to kind of strategically plan your taxes. If you have a little bit more room in a tax bracket, you could sell some of the stock strategically in the future, or pick and choose when you want to be taxed on that income, and gives you some different options. So high return, I call it dividend yield, but it's really return on capital. It's a high income player. If you're just trying to get enough passive income to live on, this pays quite a bit of passive income. Every quarter you get a payment based on a quarter of that 7.3% right now. So really interesting for anyone looking for financial independence. This one's kind of one that you can kind of plan on. And I guess conceivably you could take that 7.3% every year and never sell a single share. So instead of the 4% rule that a lot of people are aware of, this is more like the 7% rule. You can pull 7% out of your funds every year and never sell a single share of stock. You just continue to keep it. So all of those things work good for it. I guess long term, if you keep EPD for the rest of your life, you let your kids inherit it, then you get a step up in basis. So in that case, you never paid the tax on your capital. So that's something interesting. Personally, I don't know if the companies will last that long. They're valuable. They keep getting bought by other companies. So, I guess that could be one of the risks, is your company gets bought by one of the big oil majors, and then you lose your distributions. Although you usually get an increase in whatever the share price is, and you get dividends from whatever oil major buys you out. So that's something interesting with these master limited partnerships. Long term, you just keep them forever, live off the income, and pass them down to your kids, and then they get the step up in basis. So all interesting. Hopefully this helps. Again, not financial advice. I'm just a YouTuber, but hopefully this helps a little bit. Like, subscribe. We'll see you. Bye.